Debt Market Update, March 2020. FY20 was a mixed year for Indian debt markets. The key macroeconomic events which impacted the fixed income markets during the year were 185 basis points rate cuts by RBI, reduction in cash reserve ratio by 1% for a year, use of innovative tools by RBI to improve rate transmission, moderation in India's GDP growth, challenges faced by NBFCs and few private banks, rise in inflation in second half, etc. Global events which impacted were sharp rate cuts by US Fed, restart of quantitative easing by many major central banks, easing global liquidity, uncertainty around trade tensions between US and China, etc. The yield on 10-year benchmark GSEC started the year at 7.35%, touched the low of 6.06% and ended the year at 6.14%, down approximately 121 basis points. Apart from aggressive rate cuts by RBI, fall in yield was supported by ample system liquidity, slowdown in growth and decline in global yields during the year. Yield curve steepened significantly during the year, with difference between 10-year benchmark GSEC yield and repo rate increasing to 174 basis points from 110 basis points a year ago. Average interbank liquidity, which was negative during the last year, turned positive in June 2019 and remained in comfortable surplus since then. This was as a result of forex purchases by RBI, soft credit growth vis-a-vis deposit growth, lower pace of currency withdrawal, OMO purchases by RBI, and high government spending. NBFC challenges, which started post-ILNFS default, were aggravated due to concerns over asset quality of few NBFCs and HFCs. This resulted in widening of spreads for select NBFCs and non-AAA rated corporate bonds. As a result of improved liquidity and multiple steps taken by RBI and government, spreads normalized to a certain extent. However, they rose again in February-March 2020 due to rise in risk aversion amongst lenders on spread of COVID-19. But with RBI announcing launch of TLTROs, it has compressed from the highs. Outlook. Post the sharp rate cut of 75 basis points in repo rate in March 2020, along with other measures to improve liquidity, fall in GSEC yield was moderate. The GSEC yield curve steepened further, with the shorter end of the curve rallying by 25 to 30 basis points as against the longer end. This also validates our view, which we have been highlighting for some time now, that the short to medium end of the yield curve offers better risk-adjusted returns. In our opinion, the current environment offers attractive opportunity for fixed income investments because of the following reasons, apart from the aforesaid actions taken by the RBI. The recent volatility in fixed income market is more technical in nature because of India being clubbed with other EMs, which have been negatively hit from the weak global growth outlook and fall in oil prices. This has led to a high degree of selling of INR bonds by FIIs. However, with the latest measures announced by RBI, this is likely to reduce and stabilize. Apart from improving CAD, sharp fall in crude oil prices arms the government with a tool to augment fiscal revenue by increasing the excise duties. Increase in duties on petrol and diesel can increase the revenue by approximately 0.5 to 0.6% of GDP. Thus, this should cushion the expected slippage in fiscal deficit to a certain extent. Given low dependence on exports and benefits due to fall in oil prices, impact of global slowdown is likely to be low for India. This, along with a comfortable external position, bodes well for INR. Thus, given the attractive yield levels and INR outlook, Indian fixed income market is attractive for foreign investors. Additionally, The government has announced issue of special securities with no restriction on foreign holdings, which can boost GSEC demand. Most of the central banks have taken aggressive measures to provide monetary stimulus. The US Fed has cut rates sharply by 150 basis points in March 2020, taking the target federal funds rate back to a historic low of 0 to 0.25%. Alongside, it has also announced a large asset purchase program. Many other global central banks have followed suit by cutting rates and announcing other easing measures. This would further improve the attractiveness of Indian bonds. Further, the outlook on inflation seems benign, with core inflation expected to soften further due to muted growth outlook in the near term. Food and fuel inflation is also expected to decline, with strong food production and sharp fall in oil prices respectively. Thus, in our opinion, as some degree of stability returns and the FII selling abates, we believe there is reasonable room for yields to decline, and the spreads on corporate bonds should also come down to more reasonable levels. However, aggressive revenue assumptions and recently announced and planned fiscal stimulus leading to higher than estimated fiscal slippage for FY21, excess statutory liquidity ratio investments within the banking system, sharp increase in oil prices, etc. are key risks to our view. In view of the above, yields at the longer end of the curve are likely to trade within a range in the foreseeable future. Considering the aforesaid factors, we maintain our view that the short to medium end of the yield curve offers better risk-adjusted returns. We believe HDFC MF schemes are well positioned to take advantage of this environment, along with focus on credit quality and scheme liquidity. Further, the prevailing high credit spreads also create a favorable risk-reward opportunity in select pockets. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.